The concept of a global index fund is quite simple. They allow you to invest into thousands of businesses all around the world. But there are a few different types, and just a tiny difference in the name of the fund can mean that you're investing into, or potentially missing out on, over twice as many businesses. With the MSCI and FTSE global indexes, this can be a very real possibility. So let's take a look at the differences between the MSCI World Index and the FTSE All World Index, so that you know exactly what you're investing your money into if you decided to invest into one of these via a global index fund or an ETF. On paper, they might look like they do the same thing. They both invest into mid to large companies all around the world, but there are some pretty big differences that you'll need to consider before you invest. Seeing as these two indexes come from different sources, MSCI being Morgan Stanley Capital International and FTSE being Financial Times Stock Exchange, you'd expect some differences. The differences are actually quite staggering. The first difference is in the number of companies that they track. At the time of recording, the MSCI World Index tracks 1,352 companies, whereas the FTSE All World Index tracks 4,227 companies. This means the FTSE All World Index tracks over 2.5 times more businesses than the MSCI World Index. But it's not just the number of companies, they also track different regions, with the MSCI World Index focusing on developed markets, where the FTSE All World Index covers both developed and emerging markets. This all comes down to subtle differences in the fund names, All World versus World. MSCI does have an index that tracks both developed and emerging markets, but this is called MSCI ACWI. Is it any wonder that investing is so confusing to so many people? When comparing returns for the indexes, because developed markets have outperformed emerging markets in recent years, the MSCI World Index has outperformed the FTSE All World Index. Over the last 10 years, the FTSE All World Index has an annualized return of 11.7%, whereas the MSCI World Index has an annualized return of 12.5%. Over the last 20 years, it is a lot closer, with FTSE being 10% and MSCI being 10.2%. Just for reference, those performance figures are based on if you hold your investment in GBP. If you use a different currency, you will get slightly different figures, but there'll still be a similar differences between the indexes. But just because developed markets have outperformed emerging markets in recent years, doesn't mean that's always going to continue. Emerging markets, by their very nature, have more potential. Of course, that comes with more volatility, but that can always change in the future. When looking at weighting by country for these two indexes, there's two key standouts for me. The first is because China and India are classed as emerging markets, if you invest into the FTSE All World Index, those are included in the index, whereas because they are emerging markets, they're not included in the MSCI World Index. This difference also then means there's going to be a difference in the weighting for those countries that appear in both indexes. So for example, in the FTSE All World Index, the US makes up around 63%, whereas in the MSCI fund, it makes up around 71%. So as you can see, the US already makes up a very large portion of the global index, but with the MSCI fund, it makes up an even larger proportion. So when deciding between these two funds, your decision is around, do you want more exposure to the US? Or do you want some exposure to China, India, and some of those other emerging markets, which, like I said, potentially have more potential, but they might come with a little bit more volatility alongside it. There are some other subtle differences between these two indexes, such as the FTSE All World Index rebalances twice a year, whereas the MSCI World Index rebalances 4 times a year. They're both really easy to invest into via an ETF, which most platforms will offer. But for me, if you're going down the route of choosing the World Index, so that's not including the emerging markets, you are making more of an active choice. When you just invest into the All World Index, you're not having to choose a particular sector or region that might outperform. You're simply just betting on the world. If you go down the route of choosing a particular sector, region, country, for example, a lot of people invest into the S&P 500, and especially in the last 10 years, the S&P has outperformed the global index. You're banking on that continuing to happen, and you're actively making a decision on thinking that particular region is going to outperform. And it's exactly the same thing with choosing a world index over an all world index, is that you're thinking that developed markets are going to continue to outbeat emerging markets. You could, if you wanted to, invest into the MSCI World Index and then maybe have a separate one where you invest into emerging markets. And I know some people that do that. They like having that control over choosing the weightings themselves. But to be honest, you're just adding complexity for no real major gain. You may as well just invest into the world and just let it do its thing. You're investing into an ETF because you want a more passive approach. You want that hands-off approach. You want to sit back and just let it do its thing. Hope you found that useful, guys. Check out my recommended investment apps down below in the description. If there's any other ETFs or index funds that you want me to cover, then let me know in the comments below. Thanks for watching, and I'll catch you in the next one.